Hello and welcome to Finom Group. This video is intended to be part one of a three-part series entitled The Volatility Trading Complex. For those of you who are not familiar with myself, Seth Golden, or my story, I began trading volatility back in 2012 at the request of a client. Back then, I was running Capital Ladder Advisory Group with my partners, and we disseminated research reports for the hedge fund community. It was around this time, shortly after 2011, that the volatility trading complex came into a lot of new issues, a lot of new trading vehicles, if you will. And a client of mine at that time asked me to read up on a prospectus that I didn't realize was going to be somewhat life-changing. And so that's the story I'm going to kind of share with the audience here today, going through the text that I've already pre-outlined, so to speak, and simply discussing some of the key features of the volatility complex and how they lend themselves to trading volatility, keeping in mind that there is only one way to trade the equity market, and that is with volatility. It's just a matter of how much volatility you're trading with. Remember that if you're long a stock, if you're long an index, you are short volatility. That's just the way it works. Stocks tend to go higher over time with lesser volatility. If you are short the market, you are long volatility. Again, it's just the way the relationship works. The equity market, for which we'll use the S&P 500 as our guide, will always maintain varying degrees of volatility. This volatility can be managed and absorbed by investors in a variety of different ways. Having said that, there is only one way to trade the market, as I just said, and that is with volatility. So please take note of the following paradigms by directly trading volatility itself and through the VIX complex of derivative instruments, because as we all know, you can't trade the VIX. VIX is not even an instrument. It's a stochastic oscillating process. It's a derivative of S&P 500 options, if you will. And this is where it all began, basically a few years back in 2017. I was contacted by a New York Times reporter who was doing a big piece, or a special, if you will, a focus piece on trading volatility. And for those of you not familiar with 2017 specifically, some of the things that happened in 2017 we never saw before, especially when it came to the VIX or the volatility complex of tradable instruments. One of those things was that the VIX hit an all-time low in 2017. Could this have been predicted? I should say so. I actually did predict it a good 3 or 4 months before it actually hit an all-time low in the 860s, I believe, 8.60 or something like that. And here's the actual article. August 28th, it went public. August 28, 2017. I'll just read a snippet here. Each morning, the market's open. Seth M. Golden, which is just a small fraction of my middle name, a former logistics manager at a Target store, fires up the computer in his home office in northern Florida and does what he has done for years. Put on bets that Wall Street's index of volatility, and I'm glad that the author did highlight that it's the index of volatility and didn't necessarily call it the fear gauge, at least not in this particular portion of the article, because that's been a widely accepted and adopted colloquialism or characterization of the VIX for the last 25 years. But the reality is the VIX is not a fear gauge. It's a gauge of volatility. And one of the reasons that we can validate that characterization as a volatility gauge and not a fear gauge, we can go back to the 90s, the late 90s, the dot-com era, the boom-bust era, if you will, and we can look at the median average back then and compare it to well, the turn of the century, even to just 2017, and say, well, I mean, the markets were going significantly higher from 1997 to 2000, and yet the VIX, and here's all of our median and mean averages by year in the VIX from 1990. This was the mean for 1990, 23. So, you know, you got some years here where you're 15, under 13, under 14, again under 13 was the mean for 1995, 16 and 96, but then all of a sudden you see it jump. And we had our first mean reading in 1997 above 20 since the VIX's genesis in 1990. And yet the markets were going higher from 1997 to 2000. In fact, each year from 1997 to 2000, the mean VIX was above 20. So again, the markets were going higher, but we had a mean VIX above 20, not consistent with previous years where the market was still trending higher, but with much less volatility. So not a fear gauge, a volatility gauge. That's the point of that little exercise there. I've been writing many articles about the VIX for the last 5 years, maybe since 2016, to 4 or 5 years. Highlighting some of the nuances of the VIX complex, some of the misnomers about the VIX complex, like it's the fear gauge, which is not really. But in terms of the practical understanding of the VIX and how to best trade it, how to participate with the VIX complex of instruments, what I always say is you're either short the VIX or you don't bother with the VIX derivatives. You're short the VIX derivatives or don't bother with them at all. Just stay long the market, absorb drawdowns that are normal part of participating in the market, but benefit from the long-term trend, which is the S&P 500 travels higher over time. Just give yourself that time. So as you can see here in the text, markets can only operate under a long-term regime of homeostasis. What does that basically mean? It means the market likes an environment without high volatility. You know, anything over 20, in my opinion, and historically, is elevated volatility. The market doesn't like that atmosphere. Investors don't like that atmosphere. And there's no such thing. There's no probability that exists whereby volatility can persistently trend higher. We wouldn't have a market. Could you imagine, and here we are 2020 with the VIX having achieved an all-time closing level of 82 plus. Could you imagine if that was the permanency of the market for the foreseeable future? Nobody would participate. Who would put their money into a market whereby the S&P 500 was gyrating some 5 to 7% on any given day? Most people wouldn't. That's why I say and submit that there's no probability for that type of market to exist. Inevitably, the VIX has to succumb to a prolonged period of complacency, a seeking out and finding of its mode reading. That's another misnomer when it comes to the VIX complex or the VIX itself. You've probably heard this time and time again. The VIX is a mean reverting instrument. It is not, as I say, it is not. The VIX is not a mean reverting instrument. That's just another popular colloquialism, just as we've come to understand that it's called or characterized as the fear gauge. These are misnomers that need to be better understood. So looking at the body of this text here, you're either long volatility or short volatility. In order to trade volatility via the VIX complex, one acknowledges all products, all tradable products are derivatives and therefore unlikely to express a one-to-one relationship with any derivative a degree closer to the primer. What's the primer? Well, if we go all the way back to the beginning, we ask ourselves, what's the VIX? The VIX is 30-day implied volatility. It basically derives its value from the activity in S&P 500 puts and calls, the S&P 500 options. So the VIX is a derivative of what's taking place in the S&P 500 options. Now, the further we go out from the VIX, VIX options and VIX futures, and then VIX exchange traded products, the less of a direct correlation there is between the VIX exchange traded products and the VIX itself, VIX futures and the VIX itself, so on and so forth. So in kind of layman's terms, just because the VIX is going up, it doesn't necessarily mean the VIX futures are rising on that same day or to that same degree. Therefore, the VIX exchange traded products, whose assets under management are VIX futures, don't necessarily have to follow the VIX either. Long volatility trading, right, requires appropriate structure. You really have to have the right instrument. It has to be the right product, the right premium. If you're trading volatility long, more than likely you're short the S&P 500. So you need the right premium. If you're using options, you need the right strike, the right entry and exit level, as the VIX itself is completely untradeable. The aforementioned, everything that I just mentioned there, the right product, the right structure, the right premium, the right strike, entry, and exit, all the aforementioned become more relevant during high volatility regimes. Given the proximity for higher priced VIX products are reduced each passing day. Look, the higher volatility goes, your risk becomes skewed to the downside. Remember what I just outlined. The VIX has zero probability whereby it can persistently trend upward. That essentially means that VIX options will likely start to roll over. VIX futures prices will start to roll over. VIX exchange products are starting to roll over if they haven't already. No probability exists whereby the VIX can stay elevated. It has to come down in order to achieve the S&P 500 or the benchmark index overall homeostasis. That's a lot to get right if you're trading long volatility. Yeah, but I'm just hedging. I'm hedging via, long calls, long VIX options. Again, you still have to have the right product, the right premium, strike, entry, and exit. It's a very difficult exercise. To my earlier point, if you're going to trade volatility, trade it short or don't trade it at all. But I'm afraid that the S&P 500 is going to draw down. The S&P 500 is not going to draw down forever. Just like the VIX is essentially ever seeking a new all-time low, as it finally found after 25 years in 2017, a new all-time low, the S&P 500 is always seeking higher prices. It's either going to find those higher prices by way of rising corporate earnings or structure itself. The S&P 500 is constantly evolving its structure. In the past, we had financials, we had the energy sector. Those were, some of the more heavily weighted sectors in the S&P 500. It's a different market today. Technology, consumer discretionary, healthcare. Those are the top S&P 500 sectors for which that's where the greatest amount of earnings are coming out of. So to that degree, the market is only going to stay down for so long and before it reverts to where those earnings where they're coming from. If you're going to trade volatility, trade it short. Trade it short, but trade it with time. Volatility is a measure of time. In order to calculate volatility, it's the square root of time. So here, short volatility trading aligns with all VIX products, their construct, which expresses which expresses duration decay as VIX historically achieves its mode level or homeostasis for the S&P 500. Here are some of the things that I wrote back in 2017. I try to be a student of all things and an expert on absolutely nothing. It leaves my mind free to entertain the various bases of knowledge floating freely about the world. Fear is a constant. It is. We understand fear in the market. Probably one of the biggest reasons why people decide to hedge their portfolio. Knowing statistically, 80% of hedges, according to the historic COT data, the COT data, suggests that 80% of hedges never come with a profit. They're always out of the money. People decide to hedge their portfolio because they fear a market drawdown. And yet that hedging activity doesn't come to fruition. More often than not, people are simply taxing their portfolio. You can't time when the market's going to go down. It's a bad practice. It's a poor discipline. Now, the folks that come on CNBC, well, I'm hedging, I'm buying some VIX call options, or I'm going long VXX, one of the most popular and most liquid VIX exchange traded products. You see these people, the Nigerian brothers, all the time on CNBC. We're hedging using VIX or VXX call options and whatnot. But what they don't tell you is that more often than not, these tend to prove a tax on their portfolio because the market didn't roll over. It didn't even give a big enough correction. On average, the S&P 500, on average, will have a 5% correction 3 times a year. Good luck timing those 3 occurrences. And again, using the right strike, the right instrument, the right entry price, the right premium, and the right exit. Hedging is no more difficult to process than it is to go long volatility. All right, so fear is a constant, but it is malleable in the human mind and with great decay over time. I refer to this as desensitization. The human mind doesn't necessarily respond to the same stimulus the same way repeatedly. That which we were afraid of back in, let's use, for example, the 2001, 9/11, right? And the market, had issues and volatility spiked. There was a lot of fear, not just in the market, but around our nation. Fast forward 3 years later, 5 years later, 10 years later, we had many, many different terrorist attacks and plots on our country, and yet the markets didn't budge. They didn't respond the same way that they did on 9/11 and shortly thereafter when the markets reopened for trading. Desensitization. The market doesn't respond to the same stimuli the same way repeatedly. Here's an example. Can you imagine being afraid to drink Coca-Cola in the early parts of the 20th century? Now, today we think that's nonsense. It's Coca-Cola. What do we have to be afraid of other than, putting on a few pounds, if you will, and it's just an unhealthy drink. Today, that seems far-fetched to be scared to drink a Coca-Cola, considering the beverage was originally created as a medicine in the 19th century. Well, many were quite fearful when it first showed up in the retail outlets as a beverage back then. How's about the Y2K scare, right? Like the millennials today look at us and like, what's wrong with you people? There's nothing to be afraid of. But back then, believe it or not, yeah, there was consternation. There was fear over Y2K. Nowadays, we don't even think twice. 2020. Did anybody think about that decade level when it came to internet and cybersecurity, other than the normal cybersecurity issues? But it wasn't like what we felt at the turn of the century, Y2K. So again, desensitization. Something else I also wrote. It's often noted or offered that the VIX mean reverts. That is seemingly true, on the surface. It's quite incomplete. So with that said, I'll offer that if you think we've already seen an all-time low in the VIX over the years, just give it time. The VIX will always seek out and find a new all-time low in due time. It's basic psychology. It has to. So if one thinks today's VIX levels are low, they will likely become the norm over time. And again, I wrote this in 2017, a few months before the VIX hit a new all-time low. It wasn't necessarily predicting it, and I couldn't tell you that it was going to happen in 2017. This was just a general understanding of human psychology that plays out in the markets. It's just a matter of when we would achieve a VIX new all-time low. Will we see another low? Absolutely. When? I couldn't tell you. Takes a lot of a lot of factors, a lot of variables to coalesce together at just the right time to produce that new low. But we will see one, hopefully in my lifetime and yours. All right, so anyways, the aforementioned is something I wrote way back in 2017. Here's the article link. And for those of you watching this video for the first time, the body of works here will be available at phenomgroup.com. So subscribe in order to access it and refer to it in the future so that you have all the context, all the graphics, all the data at your fingertips. All right. So take a look at this table here. This is from Metrics Maestro. And again, talking about the VIX not being a mean reverting instrument. Historically, this is the mean for the VIX, 19.14. The median is 17.23. The mode, 12.42. 12.42. Now, if we scroll down here just a little bit, this gives us the frequency for which the VIX trades in these ranges, 9 to 10, 10 to 11, 11 to 12, so on and so on and so on. Look at where the VIX trades most of the time, between 12 and 13. You want to broaden it out, fine, 12 and 14. That's where it spends most of its lifetime, between 12 and 13 or 12 to 14. That's why the mode is right there. So for those that, when the VIX gets to, I see this all the time too when it comes to hedging. Well, the VIX is too low. It's at its median. Folks, that's just a speed bump in the way to its mode reading. And this is where people, lose a lot of that or tax their portfolio by going long volatility, expecting a bounce from the median or the mean even, and take advantage of that. But they don't realize the VIX these are just speed bumps. The VIX wants to get here in this range, 12 to 13 or 12 to 14. That's where it wants to be. And that's ultimately where the homeostasis we find in the S&P 500. It spends most of its time in this green section here, narrowing it down 9.47% of its time between 12 and 13. In the levels denoted above, we can identify that the mode is the lowest level for which the VIX actually seeks out more frequently than any other level. All right, let's get to the VIX. Okay, what is it? What is the VIX? As I mentioned earlier, implied volatility. Implied volatility is the market's expectation for volatility over some period of time. It's 30-day implied volatility. That's the VIX. And it's observed from option prices, S&P 500 options prices. More specifically, implied volatility is a plug in the Black-Scholes option pricing formula that tells you how large of an expected price move of the underlying, which is the S&P 500, the market is pricing into the cost of the options price. The higher the implied volatility, naturally, the bigger the expected move and the more expensive the options price is going to be. It's going to have a higher premium. Understanding implied volatility is important for understanding the VIX and, quite frankly, for understanding the overall market. So that's implied volatility. That's the VIX, folks. And remember, the VIX is not tradable. It is but a calculation. It's a stochastic process that summarizes a value based on participation with S&P 500 options. All right, this estimate is not directly stated, but is implied in how much buyers are willing to pay. If the market has been expressing great gyrations, options premiums will likely be expensive as implied volatility where the VIX is moving higher. To the contrary, in a quiet market, right, where the VIX is lower, implied volatility is moving down, premiums will be cheaper. Options premiums will be cheaper. And that also tends to lure a lot of investors into thinking, well, the market's been on a good run. It's bound to pull back here. Let me go ahead and buy some of these quote unquote cheap options. 9 out of 10 times it just doesn't work out that way. The VIX index is often referred to as spot VIX. It's the implied 30-day volatility of S&P 500s. To calculate the 30-day implied volatility of the options, a weighted average of implied volatility across a range of puts and calls is taken such that the resulting weighted average represents a synthetic 30-day implied volatility. A little complicated, I get it. But to simplify, it's just 30-day volatility of S&P 500 options. So if I was to complicate that definition anymore, I would say that the VIX is an oscillating stochastic process. It's a derivative of S&P 500 options. And remember, it is untradeable. On top of the aforementioned definition, it is lacking the qualities that tend to define an instrument. It's not an instrument. It's only an instrument in theoretical practice rather than with direct physical usage. Therefore, I can also offer that technical analysis is rendered useless for the VIX and its derivatives, which are tradable instruments. But again, if the VIX itself defies technical analysis and has no real utility because it's an untradeable instrument, and it's an untradeable stochastic process, well, then as we go further down the line of the VIX derivatives, there's even less. You could make the argument there's less utility in technical analysis for those instruments. And this is often, looked at, this kind of defying of technical analysis for the VIX. It's often frowned upon when that's said, but it is the reality. There's no logic to it. I can't trade it. Why am I using technical analysis? And what we typically see so far as the technical analysis when it comes is a descending triangle. Here's the VIX. You plot your points. Well, here was the peak and it's descending, and here we would draw this one. So kind of like a wedge pattern, if you will. And ultimately, right, you'll get to an apex point between the top trend line and the bottom trend line, right? But here's the problem with that. You never know when you're going to get a spike. I'm sure that many people here thought they were going to get a spike here, and it never showed up. Or here, they thought they were going to get a bigger spike, and it just melted further. You never know in real time when a spike is going to come. Again, there's just no utility in doing technical analysis on something you can't trade. Does not have a one-to-one relationship with the S&P 500 either. And it's just a stochastic process. There's no supply-demand of VIX. It's a stochastic process. That's it. Here's another way to look at it. to kind of draw out the logic and why technical analysis is useless. When was the last time you did technical analysis on the 200-day moving average? You didn't, right? Like there's no such ticker for it. There's no ticker for the 200-day moving average. And there's the thing also. There's a ticker for the VIX. People think just because it has a ticker, it's different than all the other stochastic processes. The 200-day moving average for the S&P 500, you name it, whatever. It could be for Apple, I don't care. The 200-day moving average is a stochastic. It's a process measurement. A stochastic is obviously not an instrument for which one can trade. We can't trade the 200-day moving average. We all agree there is no ticker symbol for the 200-day moving average, and we all agree that we don't chart the 200-day moving average. We just look at it and see, well, either it's trending higher or it's trending lower. Maybe we get a golden cross whereby the 50-day moving average moves above the 200-day moving average. But we're not trading the 200-day moving average. It's a process, and it does not have a ticker. Simply reference the stochastic. So the 200-day moving average, it just simply references, it's a stochastic process trend. For some reason, because the VIX is a ticker symbol, we just went to it right here, right? People just automatically are drawn to it and say, well, okay, it's a ticker. It's different than all the other stochastic processes. This one's different. I can't trade it, just like I can't trade a 200 or a 50 or a 100-day moving average, but I'm going to do technical analysis anyway. Again, there's no logic to it, but people do it anyway. 9 out of 10 charts that you're going to see on the VIX are the same triangle wedge pattern. And again, in real time, there's nothing you can do with it. You don't know when a VIX is going to spike. You have no idea. I shouldn't say no idea. If you have a good macro market view, you understand sentiment, you understand froth over extended moves in the market, so on and so forth. Maybe you can, have a reasonable gauge on when we'll see some type of uptick in the VIX. But even to that extent, you don't know the magnitude of the uptick in the VIX. And to compound it, it still goes back to, well, I can't trade the VIX. So what does it exactly mean by doing this technical analysis with the products that I can trade, which again are not one-to-one correlations with the VIX itself? In my opinion, don't do technical analysis on the VIX. It's just a waste of time. Yeah, but then then go chart the S&P 500. Why are you wasting your time with the VIX? As noted earlier, for trading purposes, the VIX complex of derivatives became popularized in 2009, and that was with VXX, which is the most popular VIX exchange-traded product. A VIX ETP, as we'll call it for short, exchange-traded product, most of the time, people are using them to short volatility. It can be one of the cheaper ways to short volatility and to do so with duration. The CBOE also offers VIX options. In 2004, they introduced VIX Futures. These are all derivatives. These are all instruments for which you can trade volatility. In 2020, the CBOE introduced mini VIX Futures. So the complex has grown. It has evolved to deliver more volatility trading instruments. The VIX complex has become well-traveled since the turn of the century as more tradable instruments have been created. But let's put a pin in the trading VIX complex conversation for a minute and get a better understanding of the VIX and how it relates or how it correlates to the S&P 500. Remember what the VIX is, folks. The VIX index, often referred to as spot VIX, is simply the implied 30-day volatility of S&P 500 options. You may hear me say that time and time again just to hammer that point home. You probably have the VIX ticker on your index watch list next to the NASDAQ, the Dow, the Russell, so on and so forth. So let's say the VIX is 25. In fact, let's look at it today. Here we are live. Right now we've got the VIX. It is an index on my watch list. 21.36 at the moment. All right, for ease, if you will, let's say the VIX is 25. What does it mean when the VIX is 25? First thing, note that this really means the VIX is 25%. People hate when you, for whatever reason, they just hate when you use percent next to VIX. It's become a no-no in the traveled VIX sphere, if you will. But it is denoting the VIX is 25%. Second, this means that the 30-day implied volatility of S&P 500 options is 25%. Third, based on S&P 500 options activity, the market participants are pricing in within one standard deviation confidence that the S&P 500 will move within a range of 25% over the next 12 months or 1 year period. Okay, that's annualized volatility. If you want to know what magnitude of S&P 500 movement market participants are pricing in for the next 1 month, you just divide the VIX index itself by the square root of 12. There's 12 months in the year. You take the VIX, you simply divide it by the square root of 12, which is 3.46 there. If you want to know the S&P 500 expected move over the next week, just divide the VIX by the square root of how many weeks in a year, 52 weeks in a year. And you get, 52 weeks, the square root of 52 is 7.21. For daily, and this is what most people use in terms of active portfolio management and daily expectations. So for daily volatility conversion, just take the square root of the number of trading days in a year, which is typically 252 trading days in a year. And that comes to 15.8. Here we are. 15.8, and you get the VIX value. So 25% divided by 15.87 gets you to roughly more than 1.5% daily S&P 500 move. Make it simple for yourself, folks. Just think of it in terms of whole numbers. Every 16 percentage points on the VIX. So if the VIX is 16, that equates to about a 1% move on the S&P 500 that day. It doesn't have to be in a straight line up or a straight line down. It's just basically the revolutions in the S&P 500 that day. So for every 16 percentage points, you get about a 1% move in the S&P 500 that day. So if we multiply a 16 VIX times 2, that gets us to 32% on the VIX. Essentially, we should expect a 2% move on the S&P 500 that day. Every 16 percentage points gets you, 1% move on the S&P 500. But this is good for, kind of a coffee table conversation with your friends or Jeopardy maybe one day. Anyway, all right, so here's another important factoid when it comes to the VIX. Historically, the VIX has a negative 85% correlation with the S&P 500. Some people say it's just 80%, but it's closer to 84% negative correlation. So naturally, if the S&P 500 is going up, the VIX with a negative correlation should be traveling lower. So when the S&P 500 falls, naturally, the negative relationship should see the VIX move higher. This is largely driven by the fact that people tend to buy put options to hedge their portfolios when the S&P 500 falls, thus driving up the cost of options, leading to a higher level of the VIX. This is why the VIX is often referred to as the fear index, even though there is like 16%, 16% of the time where the two are moving together. S&P 500 is going up, and so is the VIX. S&P 500 is going down, and so is the VIX. Some of you, we've seen that a lot this year. There has been a few times where they've had a positive correlation to each other. I think the most glaring positive correlation maybe a signal for market participants came the week before the market bottomed. So around the 17th of March, we saw the S&P 500 down, and yet the VIX was also down. We tend to see that at market bottoms, especially after big declines in the market like we had. And we wrote about that in our weekly research report, in fact. On March 20, can you call a bottom in the market? You can. It's difficult. I'll give you that. It is difficult, but you can. There are a lot of signals that identify market bottoms. This is something that we offer in our research reports to Finom Group members. Again, if you're looking for a lot of that nuanced detail and real deep dive analytics on a weekly basis, phenomgroup.com will get it done for you. This report was our Sunday research report on March 22nd, where we essentially identified not one, not two, but at least 5 different variables that indicated the market was either at a bottom or was forming a bottom for which it was going to bounce. And one of those, bottom indicators was the S&P 500 bullish percent index. This had just gotten to basically levels that we had seen in 2008 and had only seen, I think, 3 or 4 times in history. Bullish percent index for the S&P 500. But another one was the VIX itself. Here you go. We talked about the VIX. While indeed the VIX failed to climb on Friday, even with the S&P, the magnitude of the drop that Friday going into the weekend was significant. S&P 500 falling some 4.3%, and yet the VIX did not go higher. Was a clear signal that investors were of the opinion that a bottom was in or a bottom was forming. And there were several other indicators that we highlighted, including CBOE, S&P 500 implied correlations. When you see implied correlate, this is everybody throwing everything out, selling everything. Every asset, every stock, just selling. It's the baby being thrown out with the bathwater. Again, that is mass deleveraging of assets in portfolios. Another signal that a bottom was either at hand or forming, for which you could start nibbling at the very least. I don't discount that finding bottoms and calling bottoms publicly is a tough task, but there are indicators out there that are very suggestive of bottoming processes, to put it bluntly. So anyways, just to kind of reiterate, the inverse relationship between the S&P 500 and the VIX is about 84% historically. S&P 500 option premiums generally move opposite to the S&P 500 itself. They sometimes go their own way. For example, if the market has been on a long bull run without a pullback, and this speaks to 2017, we saw in 2017, like the VIX was in the 11s and even 10s for a majority of the year. And the S&P 500 would climb and would climb and would get with like 3 standard deviations above its 50-day moving average. And investors would take out protection. Usually when you get that, that distance above the 50-day moving average on the S&P, you get some type of corrective wave or consolidation. But in 2017, for every time you put on protection, for every time that you bought VIX call options or went long UVXY or went long VXX, more than likely it did not work out. The biggest drawdown that we had in 2017 was 2.5%. That's it, 2.5%. You were hedging. You thought you were hedging. You were taxing your portfolio all throughout 2017. In fact, I wrote an article about it because constantly Pete Najarian, John Najarian on CNBC. With the VIX at 11, we're buying the VIX. It's ridiculously cheap. You know, we get a correction. This enables us to sleep well at night. And quite frankly, you know, that's a good risk management and simply knowing your risk tolerance. If it does help you sleep at night and it's just a tool to help you do so and yet still stay long the market, okay, I get it. But if you're managing capital for other people and they see you constantly tax your profits for the year, that's a problem. It's a bad discipline. To my point earlier, going long volatility is just a bad discipline. You have to time it right. You have to have the right product. You have to get out of it at the right time. So in speaking about 2017, for example, if the market has been on a long bull run without a pullback, institutional investors will become increasingly concerned that a correction is overdue and start bidding up the price of puts. So the S&P 500 can still go higher, but the VIX is going higher with it. Premiums are going higher with it because institutional investors think we have to have a pullback. It can become a self-fulfilling prophecy in and of itself. To confuse the relationship that much further, we denote that the VIX can prove its own market dependent upon the supply-demand equation associated with industry hedging activities. There are times where the VIX just doesn't do what you think it's going to do. A lot of people don't understand the VIX calendar. What? There's a VIX calendar? Where can I get this? Seth, are you nude in this calendar? No, I'm not. And it is not a living, breathing entity that you can physically touch. There's no VIX calendar, so to speak, that you can pin up on your refrigerator. It's more of an abstract understanding. And here's how it works. So again, let me reread this. To confuse the relationship with the S&P 500 that much further, we denote that the VIX can prove to be its own market dependent upon the supply-demand equation associated with industry hedging activities. While the VIX's inverse relationship with the S&P 500 holds recognizable truths, and these are the truths up here that we just went over, it contains nuances that should be understood. These nuances can aid in your investing in volatility success or result in its demise. So what am I talking about when I say that there's a VIX calendar and how it relates to industry hedging activities? And by that, I essentially mean S&P 500 put call option activity. So the S&P 500 is an institutional complex. The options market is an institutional complex, I should say, S&P 500 options. I mean, it's $100 billion complex. And a single S&P 500 option can be upwards of $200,000-$300,000. Okay, you and me are not buying S&P 500 options. It's the hedge funds, it's the large, wealth managers, it's your risk parity funds, it's your volatility targeting strategy funds, so on and so forth, right? So these institutions, if you will, they have a common practice. They want to stay long the equity market by and large. They don't want to lose their total equity market exposure, their net leverage, if you will. But they do want to protect themselves from downside risk each and every week. So what do they do? What do they do? Well, every week they have what's called automatic hedging strategies. They tend to hedge 2% of their long equity market exposure. On Monday, the system basically kicks into gear and they will essentially buy S&P 500 put options, hedging at least 2% of their overall long equity market exposure. On Mondays, we typically see the VIX higher. Here's a snapshot going all the way back to 1990. It goes from 1990 to 2015. This is the VIX. And this is Monday. Monday, Tuesday, Wednesday, Thursday, Friday. As you can see here, Monday, what happens? This is hedging day. As I said before, this is when weekly hedges go into place on Monday. So you'll frequently see if the S&P 500 is up on Monday, guess what? In the early morning hours, so is the VIX. It's because these automatic hedging programs are triggered. And they'll be buying S&P 500 put options with a weekly duration. When do these hedges roll off? On Friday. So again, looking at our color codes here, here's Friday. And so why do you typically see the S&P 500, the VIX down on Friday? It's because these hedges are being rolled off. It doesn't matter what the S&P 500 is doing on Monday in the morning hours or on Friday. We typically see more than 65% of the time, we typically see through the first several hours of Monday's trading session, we typically see the VIX higher. And on Friday, we typically see, for much of the day, if not the whole of the day, more than 60+% of the time, we see the VIX lower on Fridays. Again, this is irrespective of what the S&P 500 is doing. It's its own index. It's its own industry, if you will, because of the industry hedging activities. Every other day is normal. Tuesday, Wednesday, Thursday. It's just a roll of the dice and what's going on in the market. But also, as you can see from the days of the week, the VIX is down more often than it's up. That's the VIX calendar. To know how this works and why it works this way is to facilitate better volatility trading strategies. And to understand, what's going on in the overall market can be disconnected from what you see in the VIX calculation as well. So kind of put this these visual aids into context. As we can see in the VIX calendar above, Monday tends to find the closing value of the VIX higher than any other day of the trading week calendar. This is largely due to the nuances created in the in the S&P 500 options market and a popularized industry practice of weekly automatic hedging. The weekly hedging exercise consists of the buying S&P 500 puts to hedge long equity market exposures, which is reflected in the oscillating calculation of the VIX and results in its changing value. These weekly hedges usually roll off on Friday and largely result in a lower VIX value on Friday. If you put this exercise under the microscope as a trader investor, it also looks a lot like this. A trader on Friday afternoon does not want, so we're starting on Friday here, folks, with the VIX quote-unquote smash, as it's become popularly known because of its tendency. But most people don't know why it has this, or they never bother to look into why it has this tendency. So here we are, we're showing up, it's Friday, it's the Friday trading day. A trader on Friday afternoon does not want to pay full fare for an option on Friday, knowing he or she is about to face 3 days of price decay before the market reopens on Monday, otherwise known as theta decay. So he or she lowers the bid for options a smidge, right? Trying to get that better premium. The VIX estimates the volatility of a hypothetical S&P 500 option with 30 days until expiration. But a trader in the real world would view that option as if it only had 27 or 28 days, accommodating for the weekend. That has the effect of lowering his bid on Friday in volatility terms. Now, we come back on Monday. Come back on Monday and voila, it's essentially 3 calendar days later on the actual calendar, but maybe 0 or 1 day later as far as the option trader is concerned. It's only 1 trading day later for that options trader, but in terms of that option, it's 3 calendar days later. You've lost time value there. She has already priced in that weekend decay by lowering the bid on Friday, though. Now, what happens on Monday, alongside that weekly hedging activity, is the resetting of those lower bids by the VIX. So it's another reason why you see the VIX higher on Monday. If it's not just because of that weekly hedging activity, it's also because the bids were lowered on Friday and they're going to normalize on Monday morning. Again, VIX complex is not like anything else out there. There's a lot of nuances that need to be better understood. So before we begin discussing some of the VIX complex trading options, if you do intend to trade volatility, I'd be remiss if I didn't offer you some of the following bullet points that you see here. Trading volatility accepts, without fail, it is of the most complex and extreme of trading strategies that one can participate alongside. Trading volatility is not akin to trading the market. It just isn't. You can do technical analysis on the market, if not for that reason alone. It is not like trading a typical stock or a bond or any other ETF out there. Bringing other strategies from other market participation, like stocks or bonds or whatever, to the volatility market will likely prove faulty and come with some capital losses until you get kicked in the butt and realize this is not like trading stocks and bonds. This is not like trading typical ETFs, sector ETFs, index ETFs. This is very different. Derivatives are different. Trading volatility with a degree of success will take time, just like anything else. Study and dedication to and understand and accepted process whereby trial and error is part of the educational experience. One of the things that I often discuss with our Finom group trading members is, especially novice traders, those who are new to the market, you're going to pay for your market experience. You are going to pay for it. You pay anything that surrounds an educational purpose and experience comes with a price tag. That's the same thing with trading volatility. Expect there to be a price tag on that education. You're not going to learn it overnight. It takes repetition, just like anything else. There is a price to pay. It is often a best practice, if you're going to trade volatility, to seek out an expert volatility trader rather than learn and trade on your own. And again, that is also what we provide at Finom Group. Well-rounded volatility targeting strategies whereby you can trade more safely. There's no safe trade. There's no safe way to trade, whether it's volatility or anything else. I liken it to sex. There's no safe sex. There's just safer sex. Get married to somebody you love, okay? That's safer sex. But trading volatility, there's no safe way to trade volatility. There's just safer ways. And trading with a volatility expert is a safer way. I hope that wasn't too, rated R for people. Anyways, the more popularized ways for which to trade volatility is through VIX exchange traded products. Again, we'll use VIX ETPs, exchange traded products, as the acronym. A list of the most liquid products is noted here below. TVIX is in here, but that was terminated this year in 2020. Some of you who are familiar with trading volatility exchange traded products remember XIV, also VIXM. A lot of products have gone by the wayside over the last couple of years and for various reasons. I began trading VIX ETPs back in 2012, as I highlighted earlier, at the request of a client and through researching the construction of the products. And speaking of the construction of the products, the VIX exchange traded products, whether it's UVXY or VXX, and again, those are the most liquid and the most popular, excuse me, we want to know what their assets under management are. Construction of the product is, the terminology we'll use is the assets under management, or AUM. That's the acronym, AUM. What is UVXY? What is VXX? I more frequently trade UVXY, but I am a long-term investor in VXX. That hasn't worked out very well so far as VXX over the last couple of years, but trading UVXY short has worked out quite well. And I'll get into the reasons why I've held short VXX for now 2+ years, and yet over that time period, it's basically back to or around its all-time lows, having gone up, 100+% here and there and come back down to its all-time lows. So the assets under management, why do we need to? Well, you need to know what you're trading, right? What is the construction of the instrument? Stock ETFs have various stocks under management within the ETF, right? A sector ETF like the technology sector ETF has Apple in it, has Microsoft in it. Those are the stocks under management within the ETF. A bond ETF, same thing. It has different maturities within the bond ETF. VIX ETFs or ETNs, which are exchange traded notes, and that's why we just say blanket it as VIX exchange traded products, because you have a mix of ETFs versus ETNs. So for the sake of our tutorial here, we'll just call them VIX ETPs. They have VIX Futures under management within the VIX exchange traded product. And there you have it, VIX ETPs. Assets under management are largely VIX Futures. Remember that the VIX is a derivative of S&P 500 options. So let's look at the chain of custody for VIX derivatives, so to speak, in order to better understand how to track and what to expect from a VIX exchange traded product's price action. Remember, here's where we start, the S&P 500. That's our primer. It's our ace. This is the alpha dog in the chain of custody, if you will, of derivatives. This is the primer for which everything feeds off of. This is number one. And then you have S&P 500 options. And then you have the VIX, right? The VIX is a calculation of 30-day implied S&P 500 option volatility. Branch off from the VIX, you get VIX options and VIX futures. Way back here, you have VIX exchange traded products. A lot of times what we'll see out there in social media and what have you, and a lot of the emails that we get to Finom Group are, can you explain to me why if the S&P 500 is going down and the VIX is going up, how in the world is UVXY going down? And what I will emphasize to or respond to that email with is this chain of custody right here. Just because the VIX all the way up here is going up and the S&P 500 all the way out here is going down, that does not mean that UVXY will go up with the VIX. It will do what VIX futures are doing more or less, most often more. So that's the reason why you have to know the construct of these VIX exchange traded products to better understand why they're moving the way they are moving in price value. So if we start from the S&P 500 itself, a VIX exchange traded product is basically a 5th degree derivative of the S&P 500 and a 4th degree derivative of the VIX. The further from the S&P 500 we travel with respect to tradable instruments, the less effective the correlation, to my point about emails and answering questions. As it pertains to the VIX, the same is true. So for the sake of understanding the price action of UVXY or VXX, they will track more accurately to VIX futures and less so to the VIX itself. This is very important to understanding why UVXY and VXX trade as they do, mostly to the downside over time, because most of the time, VIX futures are in a state of what we call contango, and we'll get into that here and now. So let's talk about those pesky VIX futures, the assets under management for UVXY and VXX, as well as other VIX ETPs. While spot VIX is not investable, VIX futures can be bought or sold directly. A VIX futures price represents the market's expectation for a 30-day implied volatility of the S&P 500 on the expiration date of the particular future that you're trading. It's a bit confusing for novice traders, but visual aids they're forthcoming, folks. This is VIX futures term structure here. And as you can see, we got 1, 2, 3, 4, 5, 6, 7, 8 monthly contracts that are trading at any given time. You have the December futures contracts, which we are in that monthly futures cycle as we speak. And then you have a January future, February, so on and so forth, out into, well, basically late 2021. The slope of the curve indicates, you know, what term structure is expressing. Are we in contango or are we in backwardation? And that is a key necessary understanding when you are participating, trading VIX exchange traded products like UVXY and VXX. And with that, we will pick up right here in our next series, talking about contango, talking about backwardation, and how to more accurately position yourself in the volatility trading complex. So I know we've gotten a little long-winded here. There's a lot of information to regurgitate in the future. But for now, this is where we'll leave you. VIX Futures term structure. And with our next video, we'll get right into understanding the difference between contango and backwardation and how to use term structure as a risk management tool. One of the things that I always say, VIX Futures term structure does not tell you how to trade UVXY or VXX or SVXY, if you will. It's a risk management tool. It encourages using duration as your guide to trading volatility. So thank you everybody for joining us here in our volatility trading series. We'll pick this up again here later this week.